Over the past 3 months, nominal wages have grown by the largest amount for a single quarter in recorded history. Wages rose by 1.3% for September quarter, higher than any other on record. Overall wages are up 4% in the past year, rising even higher in the private sector and a healthy 3.5% in the public service. For his analysis, let's bring in Shane Oliver, Chief Economist at AMP, who we have on regularly. Shane, great to see you. What's your overall read on this number? Comes in healthy as expected.
That's right. These numbers were expected to be stronger than they have been for a long time. In fact, that 1.3% number was bang on most economists' forecasts. We know that the Fair Work Commission granted an increase in the minimum wage of 8.6% or thereabouts, starting, of course, this financial year. And, of course, there was an increase in award wages of 5.75%. That acceleration in both of those wage categories would have added 0.3%. So were it not for that happening, wages growth would have been 3.7%, not 4%. But that's the main thing driving it. Obviously, we saw the increase in wages for aged care workers. We've also got the public sector service wage caps being removed. And, of course, we've got a strong labour market. So no great surprises here that we've seen that further increase to 4% on an annual basis.
Would there be any concern from these numbers from the RBA perspective?
Look, not significant concern. If you look at the forecast they put out last Friday, these numbers are fairly consistent with that. They're probably a little bit on the high side, but don't forget the RBA's own forecast for the end of this year and for the first part of next year were for wages growth of around 4%. So that's what we're seeing. We're seeing many more workers get higher wage rises, and I guess in that sense it's not a great surprise. It's a little bit on the upside, but I don't think it's enough on its own to trigger another rate hike from the RBA. To get that to occur, we'd have to see, I think, stronger data for jobs, which come out tomorrow, and then retail sales, and of course we get the inflation numbers that come out in a few weeks' time. But on its own, I don't think it's enough to tip the RBA over into another rate hike because it's broadly consistent with their forecasts.
Indeed, and I know you're bringing the economic perspective, and you're an expert in that space. I guess anecdotally, we speak to people, and I know certainly in the construction sector, speaking to many people in this place of the ACT, where it's always seen as a bit of a bubble in an economic sense, but they're copping it in a big way due to the rates. So anecdotally, you get this feedback that people are really hurting, yet the numbers are yet to get to the point where we're definitively saying that the RBA won't move again. There's still a chance they might go in December, Shane.
There is. Look, I do worry that the RBA is going too far, or too far too fast. I think that it would have been wise to extend that pause for a little bit longer. I suppose I'm one of the few economists who've been around since the 1980s, and I remember what happened back then. Interest rates were crept higher and higher and higher, going from 10% to 18%. Of course, back in 1988 and 1989, the economy held up right through that period. Unemployment, in fact, fell right through that period. Then, of course, we get towards the end of 89, and I think there was a well-known observation from someone associated with the government at the time who said we could feel the economy snapping. And, of course, that was evident in the early 1990s. So that pain that you're hearing about out there, maybe not in Canberra, but elsewhere, is becoming more evident. The RBA's own analysis of households suggests that 1 in 7 households with a mortgage were cash flow negative back in July. Now we're towards the end of the year, and that number will be even higher. That's people where their mortgage payments and their essential living expenses are greater than their income levels. So I think there is a lot of pain down the line here. It's just that many of these indicators we look at, whether it's jobs, wages growth, inflation, they're lagging indicators of the economy. They often tell us what happened a while back, or alternatively, like those wage numbers today, they're affected by a administrative decision, as we saw with the Fair Work Commission. So yes, those numbers are strong, but I don't think they're a good guide to impending strength for the economy. If you think about it, this is just going to put more pressure on construction companies who see their wages go up at a time when the material costs go up. And, of course, they've got rising interest costs. And we've been seeing a steady stream of construction companies or home building related companies go under recently. And I suspect that will continue.
Absolutely. Yeah, well, certainly that was part of that feedback that I've received. Definitely a few and many staff being put off as well in that space too. Shane, appreciate your time. Chief Economist at AMP. We'll see you soon.